Hey, Jeff Garber, mortgage expert. Hope you are having a great day. Hey, I want to take a couple minutes and explain to you a strategy that we're using right now as rates are rising. It's called a temporary buy down. And here's how it works. We're going to start right here in this box. So let's assume you have a loan amount of $300,000. And let's just pretend that today's rate is 6.88%. And that will give you a principal and interest payment of $19.71. Now, with the temporary buy down, let's say that we decide to do a 2-1 buy down. So we would come over to this column right here. And what that means is that we would be able to reduce the interest rate on the loan for year 1 would be 4.88, year 2 would be 5.88, and year 3 would be 6.88. Basically, years 3 through 30 would be 6.88. Now, in a 2-1 buy down, that means that the first year you're going to have a 4.88 rate, and your principal and interest will be 1588 instead of 1971. In the second year, your rate would be 5.88, and your principal and interest would be 1775 instead of 1971. So if you come down here, the way it works is we go to our 2-1 buy down. This is going to tell us the cost to get the buy down based on that loan amount. And that's around $7,000. All right. And I'll tell you where that's going to come from in a minute. Now, that also tells you that the first year, your mortgage payment would be $383 lower than if you had the regular rate of 6.88. Year 2, your payment would be $196 lower than if you had the regular rate of 6.88. And then years 3 through 30, the loan would go back to the original 6.88%, and it would stay there for the life of the loan. Now, the idea behind this is if we can get your payment lower for year 1 and 2, and mortgage rates come down and create a refinance opportunity, then there's a chance that you may refinance before you even get back to year 3 at the 6.88. Now, worst case scenario is you don't have a chance to refi, and you would be at the 6.88, and you would have to be okay with that payment. And that's an important factor. We are not using this strategy to qualify people for homes they cannot afford. So if you can afford the payment at 1971, but it's a little bit higher than you'd like it to be based on your budget, well, how would you like 1588 for year 1 and 1775 for year 2? Does that help you out at all? If so, then a temporary buy down strategy might be for you. Now, there's a cost to do this. However, the good news is the buyer, or you as the buyer, do not pay that cost. In this example here for a 2-1 buy down, that cost is around $7,000, and we can get that from the seller in the form of a seller assist. So as you can see, we can use the seller's money to pay for, in this case, a 2-1 buy down. 2 meaning it's going to go down 2 percentage points for year 1, 1 percentage point for year 2, and then back to the original rate of 6.88 for years 3 through 30. Now, we also offer a 3-2-1 buy down. Imagine your rate at 6.88. Year 1, it would be 3.88. Year 2, it would be 4.88. Year 3, it would be 5.88. And then years 4 through 30, it's back to 6.88. And then if we go back to our chart, you can see that we'd be saving $560 a month year 1, $383 a month year 2, and $196 a month for year 3. All right, now the cost of that is going to be a little bit more money. So if we can get a seller assist for about $14,000 and it fits in to program guidelines, well, then we could possibly do a 3-2-1 buy down. And on the opposite side, what if we were able to just reduce the rate by 1% for 1 year? Well, we can do that too. We can do a 1-0 buy down, and that will cost about $2,400 or so, and that could reduce your payment by $196 for that first year. So as you can see, we have 4 varieties of the buy down. Now, not every lender is going to offer all 4 of them. I'm pretty sure most lenders today are offering at least some variation of the buy down. But as you can see, it's a pretty powerful strategy to help with affordability for a couple years with the intent to refinance before you even get back to the original rate if the market allows. Now, I see what you're saying. Well, if you're going to get a seller assist, all right, let's say you're able to get a seller assist of $7,000 or even $13,000 or $14,000. Well, then maybe you also would want to consider a permanent buy down. In other words, if today's going rate is 6.88, all right, maybe we can use some of that money to buy down the rate permanently. Maybe we can go from 6.88 to 6.25 with this money. And that would mean that you would have 6.25 now for the full 30 years on the loan, also using the seller's money to achieve this. Okay? Now that would make sense probably if you don't believe that there will be an opportunity to refinance. If you're on the wagon that, hey, rates are going to stay high for a long time and you want to take advantage of seller assist money that you can get, well, then you do a permanent rate buy down. If you're on the wagon that says, hey, you know what? There's a pretty good chance in 1 to 3 years that the next refi boom will come and that you'd be able to get a better rate, well, then you could use the seller's money for a temporary buy down at that point in time. And third option is if you were okay with the higher rate today, you could actually use the seller's money to actually help pay for some of your closing costs and keep your out-of-pocket money lower. So again, if you're in the camp that, hey, I'll take that free money right now, I'll take the higher rate, and maybe I'll refinance in 1 to 3 years if rates come down, well, then take the seller assist and use it towards closing costs. So the idea behind this is to let you know there are strategies. There are strategies out there for a higher rate environment. All right. One of them is a temporary buy down, which I've just showed you. One of them could be a permanent buy down, which we could use seller's money to pay points and buy down the rate permanently. One of them is an adjustable rate mortgage. All right. Some adjustable rates are pricing out pretty good. So maybe you do an adjustable rate mortgage for 3 years or 5 years and then refinance into a lower rate if and when the market allows. So as you can see, there are some strategies. I wanted to show you this quickly. If you have any questions, reach out to me. Again, with this calculator, I can change this in a second. If let's say the loan amount's 280, all right, and let's say rates creep up to 7.25. All right, well, here's your answer. If you want a 2-1 buy down and have to have 5.25 the first year, well, the cost of that would be $6,600, and you would save $364 a month all of year one. Okay, so this isn't something that should be sold to you. This is a strategy. It should be explained to you, and you should know the pros and cons of it. You should know your budget. And again, I have to reiterate, this product should not be used to get you a lower payment to make you be able to afford the loan in year one. We have to make sure that you're aware that, hey, worst case scenario, this loan is going to get back to that par rate. If it's 7.25, then we want to make sure you qualify for that payment. Okay, you have to be careful. People will package these up and sell you on the emotion. We don't want to do that. But the good news is there is strategies available for when rates are a little higher. I hope this helped. If you have any questions, reach out anytime. Be happy to help. Have a great day.